The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we look at Tuesday's trade action, pretty bearish day across the commodity trade throughout grains, livestock. Chicago KC wheat held in there okay, but overall just a lot of bearishness, a lot of uneasiness, it feels like, in the trade. Here to walk us through what he saw and discuss it, we welcome in once again this week our good friend Brian Splitt with agmarket.net joining us. Brian, great to catch up with you again, sir. I hope you're having a good week here so far.
Yeah, Jesse, so far so good. We'll be in Orlando later in the week for the Classic. So looking forward to seeing you down there.
Yeah, looking forward to seeing you as well, and looking forward to seeing a lot of growers down at Commodity Classic. I know that's always a fun event. A lot of folks take advantage of that as kind of a vacation of sorts, and so and also just a lot of information to be learned there too. So looking forward to the next couple of days in Orlando. Before we get there, though, as I alluded to, these markets, just kind of a bearish attitude on the day. Fed Chair Jerome Powell speaking before the Senate Banking Committee, that seemed to be one of the big headline items that drove the entire trade on the day. I know the dollar surged higher. You mentioned to me a big drop in silver before we jumped on air. So it just feels like a lot of this uneasiness with recession, inflation, and this outside broader market feel really kind of weighed into commodities on the day on Tuesday, Brian.
Right. So with Chairman Powell's comments essentially saying that interest rates are likely to go higher than they originally thought they were going to need to go, and maybe at a faster pace. So, there's different things that price in the probability of a 25 basis point hike for the next meeting or a 50 basis point hike. So I think after the commentary, I was reading that I think it's about a 70% likelihood that we'll see a 50 basis point hike on the next announcement. So more of a risk-off attitude because of that, whether it's equity trade, gold and silver. So prior to starting the recording, silver was down about $1 an ounce. Anytime silver moves $1 in a day, that's a pretty big day. And we did see some kind of mixed trade in the grains. Beans, the market that pulled back really the most, but was up the most yesterday. Meal corrected today after making some new contract highs last night. We actually had wheat finish positive, not aggressively, but I do think there's quite a bit of short wheat paper that's tied to bean length. And so with the beans pulling back today after a big run yesterday, wheat was down hard yesterday with beans up. So I think we saw a little position squaring there. And then corn's just kind of stuck here for the short term. I will say I do like where the March corn made lows last week. It was at 623.5. That's while in delivery. The December contract made lows while in delivery at the beginning of December at 623. So effectively, we've found value while in delivery at the same spot. So hopefully we could see the May contract do what March did after the Dees contract expired, and that was a move back up towards 680. So we'll have a report tomorrow that'll go through domestic balance sheets, revise the global production numbers, and see where we go from there.
I like your thoughts of how you think some of this wheat paper's tied to beans here. It makes sense to me, just the way the markets have acted the last couple of sessions. We we flipped the calendar to March. We had some good money flow into that soy complex, but wheat, not so much. But then seeing that kind of that reversal today, what do you see? Can you expand on just your thoughts with how you think some of that is tied together here? Is there anything chart related you're seeing that indicates that? Is it just some things you've heard in the trade when it comes to the funds and some of their activity? What are you seeing, Brian?
Yeah, so if you kind of go back a year ago, it was buy everything, right? Buy
Mhm.
corn, buy bean oil, buy wheat, buy corn. And it was the same for energies, right? Let's buy crude oil, let's buy heating oil, RBOB, natural gas. And so now here we are a year after the invasion, and it doesn't seem like the fund manager wants to own everything. If they're going to buy one thing, they're going to sell something else against it. And so recently, when you think about what crop has seen a continued weather story, which is continuing to decrease production estimates, that's the soybean market, especially because of the conditions in Argentina. And then when you think about a market that has generally seen an improving condition for some of the recent rains that have come through in some of the hard red growing regions. And granted, yes, the crop conditions are pretty poor. So that's something that we're going to be mindful of as we start to really come out of dormancy here.
Mhm.
But I think the fund manager is in that mindset where if we're going to come in and buy beans today, we're selling something else against it. And so Jim McCormick, Jim, we kind of joke day to day. It's like, geez, if we just knew which one to buy and which one to sell on a day to day basis, you could do really well. And that's just how it's been trading actually for the last couple months, where one day you get beans up and corn and wheat down and vice versa.
Well, and that's a great thing you mentioned there. Just seeing how it trades and wondering if you could figure it out, you'd be in a good spot. But I think for a lot of farmers, they just see it and they see these moves, and this volatility and whatnot. And it sometimes maybe has them frustrated, but it is what it is. It's the market. Thinking ahead to Wednesday's WASDE report, you brought up Argentina, and I know as well you brought up the wheat conditions coming out of dormancy. What do you expect on that WASDE report for March outside of the Argentine numbers for sure? I know we're going to see a cut. Do you see anything else that you're really worried about as we look at that report, or anything you're watching from USDA, Brian?
Well, I think one thing the trade is still looking for is a revision lower for corn for export. And that would just be simply because of the pace analysis that we've got. But I think the USDA needs to be careful in doing that if they're going to continue to reduce the South American production numbers. So we've got a Argentine crop that is still experiencing hot and dry conditions. We had that frost a couple weeks ago. And so with that, I feel like if we're going to keep seeing that Argentine crop get smaller, that just leads us to probably seeing more business come out of the U.S. for any world buying of corn that needs to be done. Now, whether the trade is right or not, and China needs to come in and buy corn, who the heck knows? It's China. I frankly don't think they need to buy what they've been buying the last couple of years, and that's part of the problem with the balance sheets and the way they started is the USDA was still looking for China to come in and buy at a somewhat aggressive pace, and surely more aggressive than they were buying pre African swine fever, right before they changed their feed rations. So they probably overshot Chinese corn demand. But regardless, as we see Argentine crops continue to decrease in size, that just places a higher likelihood that we're going to see corn exports kick in. So I think USDA has got to be careful about really relying strictly on pace analysis. And then we've got the safrinha corn crop in Brazil. And the later that goes in, that just pushes the key pollination time frame into a period where they are more likely to have a hotter and drier bias. So as of right now, I don't know that the USDA is going to make any revisions for Brazil's corn. Argentine corn and Argentine soybeans, absolutely. Although they won't come down to where the private estimates are. I mean, we've heard this week private estimates for beans of 25 million tons, and USDA is still at 41. So they'll probably come in somewhere in the mid 30s if I had to guess, but they're not going to come in at 25 to 30. And I don't think the size of the crop is going to be that either. I think we're overdoing our downside estimates right now on Argentine beans, but time will tell.
Time will tell. On corn, just looking at where things, settled up Tuesday, thinking about corn and the balance sheets and the export side that you mentioned. I know you and I've talked before, and I've talked with the team about your recommended percentages to be sold on, especially new crop. I mean, should farmers be thinking about some of those things, making some moves ahead of the report, putting some defense in, protecting that risk, or is this a moment to maybe just hold tight and see what the report has to say, Brian?
Yeah, I'm never going to be the guy to tell a producer not to, protect risk if that's something that they feel that they should be doing. My job at that point would be to just try to help them find the most efficient way to do that. My own personal bias is that with what we've seen happen over the last couple weeks in corn, how we continue to trade quite a bit like 2013, I think we could actually maybe solidify the lows that were made last week. And start to try to bounce going into the end of the month and into the planning intentions report. Now, if we got that bounce, and let's just call it maybe around March 20th to 25th, somewhere in that time frame, then I would be much more aggressive in trying to layer in some coverage ahead of that planning intention data, especially for corn.
We are having a conversation today with Brian Splitt of agmarket.net, joining us here on Market Talk. Brian, just overall to kind of wrap up our grain discussion here and just the broader picture. I know crude oil has been just a little bit, all over the place on Tuesday. It was kind of looking like it was down 2 to 3% here as we're talking right now. That's obviously an influence on this market. As a whole, how much are you watching crude still, and how it is weighing on grains and oil seeds, Brian?
Yeah, I mean, energy values are extremely important to the overall commodity outlook, especially when you look at the correlation with corn for ethanol, just general energy consumption. Then you look at some of these long-term correlation studies for bean oil and crude oil, especially as we get more into the renewable diesel atmosphere. So the price of energy is extremely important in the big picture for grains. I'm concerned that this crude oil chart has what appears to be a potential head and shoulder pattern forming. If it validates, that would project down to about $63 a barrel. I've talked, we do our Wednesday technical videos every week. And over the last couple of months, as people try to ask, what might be a good equilibrium price for crude oil, seems to be, in that $65 a barrel area. So I wouldn't be surprised if we eventually work our way down there. I think you're going to continue to have some support around 70, just because the administration has said, hey, we're going to be refilling the strategic petroleum reserves at 70 and below. So if we do see more of an economic downturn, that might provide some support under the energies big picture. But I think also the administration, I would hope, is smart enough to maybe pause their buying if they do see more of a prolonged downturn in values, and maybe try to be a little bit more patient. So just like, an end user for corn, you could say all you want, hey, if corn gets to 650, I want to come in and buy it. But with the speed that we came off those highs, a lot of those end users that wanted to buy 650 as it got close said, hey, this is coming down pretty fast. I'm just going to hold off a little bit and see if we don't go down a little bit more. I think the administration could do that if we see more of a bigger picture break in commodity values.
Great thoughts. Give us some insight into the livestock trade on Tuesday here, Brian. Cattle, just relatively mixed, quiet. I'd say overall, just really didn't do a whole lot. The feeder cattle market, I know it started the week screamed higher, and then we just kind of just treaded water, it felt like, on the day. And hogs were mostly lower too outside of the front month. I wonder if a lot of that was probably tied to just the broader economic picture and some of that bearishness in the overall trade on the day.
Yeah, I mean, I feel like a broken record when I talk about cattle. I mean, it's the same story. Everybody knows the fundamental picture is friendly. We've seen good gains. All I can really continue to tell the cattle producer is that options are very cheap. Options are trading at 8 to 9% volatility. So if you want to be bullish and look for the market to continue to go higher, that's great. Puts are not a bad thing to own in the meantime, especially as we're going through all of this uncertainty about the economy, and if interest rates are going to have to move up faster than what the Fed thought they were going to be, and to higher eventual target rates than what they were originally planning. I think that is probably the biggest risk for cattle, is just the perception of what type of demand we're going to see for beef if the economy softens further. So feeder cattle, geez, you have some of these fall contracts trading of 220 plus. So I think we're probably due for a correction. I wouldn't be surprised to see things back off a little bit. Looking at lean hogs, yeah, I mean, this April contract should continue to find good support in the 83 to 84 area. We did today. But I was a little more hopeful that we'd see this April contract bridge the gap between where it is and where some of the summer month values are. And maybe today was the start of that with the aggressive bull spreading that we saw. So I have to imagine, I haven't looked at it on a chart, but I would imagine like an April, June or an April, July spread probably put in some pretty significant lows and made a major reversal here this week.
Yeah, I would have to say so as well. Just the strength in that front month April contract was really felt impressive on the day Tuesday. And to your point, if we see any softening of demand with the economy, especially on the beef side, I mean, there's one thing, Brian, to think that, okay, if you want a steak, people are going to go get that steak if they want it. But at the same time, too, instead of getting, say, a ribeye or a sirloin or filet mignon, maybe they're getting a New York strip if money's tighter. So I think to your point, it's going to be interesting to see just how this whole economic picture weighs in. I think that if there's anything that could aid us in a correction in this cattle market that seems to be so bullish, it could be some of that retail economic demand and concern there if we do have some of that come through, Brian.
You're right. I mean, I love beef. I would eat it almost every day if I could. My doctor tells me not to, but I tell you what, I mean, when times are good and we're grilling, I'm going to the counter. I'm buying prime ribeyes. I'm buying prime, strips, buying some fillets for the wife because that's what she likes. But when we're lean, well, I'm going to go to the carniceria and I'm going to buy flank steak, and it's marinated flank steak, and we're having carne asada instead. And that's delicious also. And so I think that's, to your point, you could see some of the consumer behaviors change, and it's going to become a demand for different cuts.
Definitely. Very, very true. Before we wrap it up here today, sir, I always appreciate the time and insight, and I'll leave you with your favorite question. I'll just leave it kind of open for you here. Anything else you want to mention or reiterate for folks as they're taking a look at the markets here as we work through the week?
Yeah, I would just say, recently we saw that Ag Outlook forum, and it kind of threw people for a loop, the reaction that we had, because generally the trade doesn't react as aggressively to that data set. But I think it just really opened some eyes that if we get 91 or more million acres of corn and we have a good yield, our balance sheet's going to change rather dramatically just in one growing season. And if we end up with a good safrinha corn crop, that is going to compete with our exports sooner than we would like. And so I think you have to, as a producer, just be mindful of the fact this is going to be the most expensive crop we've ever planted. And if the balance sheet changes dramatically, we're going to see the fund manager, instead of trying to buy everything and be long corn and be long beans, we're going to go back to a 2013 scenario where they're probably going short at some point in the growing season. And they're going to be pressing the producer below cost of production levels, knowing that the producer's on the ropes. And so it's going to be a weather market, that it is every year. But I think you have to be vigilant this year and make sure you have some kind of coverage, even if it's just owning puts. But I think if you look back at history and go a decade ago, 2023 corn is trading a lot like 2013 corn. High so far for the year is the first trading day of the year. We were at 590 right at the beginning of February, just like 2013. And in 2013, we were making lows at 410 come fall. And so if you just play that out and what that would mean for your operation, it might light a fire under your butt to be a little bit more aggressive.
look at history to hopefully influence some future decisions and not repeat any mistakes that may have been made. Brian, always great to catch up with you. If producers have questions, I know they can reach out to you, the team there at agmarket.net, very easily, can't they?
Yes, general line is 844-4AG-MARKET, so 844-424-6758. Reach us at the website's www.agmarket.net, and my direct line is 815-665-0463.
Always great to chat, buddy, and we will see you this week in Orlando, Florida for Commodity Classic. Thanks for joining us today.
All right, see you in a couple of days, Jesse. Appreciate it.
Brian Splitt with agmarket.net joining us today. Let's go do it for Market Talk. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.